All right, good morning. So, last time we're going to be meeting for this course. Today, basically, I'm going to be providing my side of the review. If you have any questions, this will be a good time to ask. So, we'll go through a quick recap of what we've discussed in this course and then some information about the exam itself. All right, so what's the point of this class? All right, so in order to evaluate things, we need information, right? And so the entire point of a financial statement is to provide information. There are some general criteria that we need for financial statements in order for them to be of use, right? The first one, that they're useful, right? Kind of self-explanatory, all of these items here. But in order for a financial statement to be of any relevance, it has to be useful and it has to contain information that pertains to its value, right? Relevance, can we use this information to evaluate managerial performance and decision-making, evaluate the value generation of a company? Is it accurate? Is it actually representing the information that it says it does? Is it related to the cash flows generated? Does it cover all the information that is related? And are companies able to put forth this information on a neutral basis, right? Meaning they're not trying to intentionally inflate, deflate particular values, and that their information that they're providing is accurate. Okay. And if any of this, if any information changes, financial statements have to be updated in order to maintain all these characteristics. All right, so exactly what are financial statements? Basically, they're ways of reflecting information about a company. Their ability to generate revenues, how they manage their costs brings toward the income that they're generating in a given time period. Right, so the income statement reflects value being generated on an accounting basis, on an accrual basis. All right, so income is our revenues, net costs, including costs of producing those revenues, interest payments, taxes, down toward the bottom line. All right, so we use income statements to evaluate a company's performance. Again, this is on an accrual basis. There is a difference between accrual value and true economic value. That's why we make adjustments in order to arrive at cash flow. Then we have the balance sheet, showing sources and uses of cash. Right? It's important to think of liabilities as a source of cash to a firm because that's what it is. Right? When a company issues debt, yes, that is an obligation that the company is tying itself to. They have to repay that debt on the schedule that they announce in the offering. But it is a source of cash for the company to use, hopefully for productive purposes. Right? So sources and uses of cash, that's what a balance sheet reflects. Over time, it should show growing balances, right? We should see that companies that are generating value have retained earnings that they can plow back, reinvest within the firm. So over time, a healthy balance sheet is going to be growing. And the last of the three major financial statements is the cash flow statement, right? So to a significant degree, income statements can be managed to reflect better than actually occurred incomes, right? So the cash flow statement came about in the 1980s because when you make cash adjustments to the accrual-based generated income statement, you can reflect the actual value being generated or destroyed. So that's what the cash flow statement is a result of, is trying to be more informative and reduce the ability of people to be non-neutral in their financial statement presentation. All right, so what do we use this information for? Basically to make decisions. Right? You have to be able to make decisions when we're looking through a company's financial statements. Right? Specifically, we're trying to figure out what the value is for a firm. There are external decision makers, so whether or not you're going to invest in this company, whether or not it's worth lending the money to if they're trying to raise any cash. Internally, you can gauge whether the decisions that management are making are adding or destroying value. Right? That's part of the analysis that you look at cost of change. What sort of decisions were made? How did that affect change? And what was the resulting effect of that change? General creditworthiness of a company. And also, are they law-abiding? Right? And there's been increasing attempts to tie the top decision makers of a company to the general law-abidingness of a firm. Whether that's had a significant effect, I'm not entirely positive, but it certainly has improved the informational content in financial statements. Right? When a chief executive officer, CFO, if they are tied to the accurateness of the financial statements being presented, right, facing jail time and fines, we found an increase in the informativeness of financial statements. So these are the general areas that we're concerned with when we're looking through financial statements: externally, valuing the company; internally, how well are our decisions coming together. All right, so where do we find this information? Edgar is a free available resource that everyone has access to. Every bit of information that you want in a company's filings is presented there, but there are other ways that we can get information, right? So part of the problem with Edgar itself is it's difficult to aggregate data, right? As you've seen going through your project, you spent a lot of time and effort putting together that financial information and understanding those financial statements. There are resources that we can use that make it much easier to aggregate that information to evaluate company performance, right? So Edgar is free information. It's all of the publicly available information that a company has ever posted available on Edgar. Oh, not ever posted. I think it was sometime in the 90s that they started mandating companies file their reports there. But all publicly available information on a company is available through Edgar, through the SEC website. But there are advantages to other sources of information, right? If you search up a company's ticker, you can get a lot of market information on the company's stock, share price, number of shares outstanding. Over time, there's been increasing use of paywalls, unfortunately. So it's not as easy to find valuable, freely available information, but the Dan Moderne website, Ken French website that I listed links to on the links page has free information, excellent resources. Dan Moderne, especially at the industry level, Ken French data at the market level. And other great uses, CRISP and CompuStat data sets are great for historical examination of companies. Bloomberg is very popular in industry. Capital IQ is also a great source of information. All right, so we have lots of information available to us. Being able to put that information together into digestible means is important, though, right? Because as you've seen going through a 10K, there's a lot of information there. It's not necessarily all relevant to the bottom line, how much value is being created or destroyed. All right, so it's as important to understand where the information is coming from, to understand what is the information that's actually relevant to decision making. So to that end, what are the steps we can take to evaluate these financial statements? Common size analysis is the baseline, right? When you do a common size analysis, you scale everything by the relevant measure in the financial statement. On the income statement, you're scaling by revenues. On the balance sheet, you're scaling by assets. That just gets you a percentage basis on understanding the ties across the financial statement, right? What does a company's net income look like relative to the revenue? Net income may have nominally declined, but if it increased proportional to the total revenue being generated, then they produce that revenue more efficiently. What you have to look at is what's going on at the top line of the company's name, right? So common size analysis gives us that basis to evaluate companies' performance. Then we have cross-sectional analysis. So looking across companies in a given time period. And we can compare performance. That's what you basically did in the last part of your project. You examined the overall industry and gauged what is the relative performance of companies that you've included in your industry. We also have time series analysis. So evaluating a company's performance across time and over history. We didn't cover it in this class, but you can combine those two as well. For panel data analysis, which is looking cross-sectionally and over time. We've also looked at cause of change analysis, so pinpointing what exactly changed in the line item and how did that affect the bottom line. Right, and these are all great steps to take when evaluating a company's performance. Right? Remember, the nominal values that you see are only the starting point for examining a company. If you just look at net income and nothing else, you're making a relatively uninformed decision because there are so many other ways to evaluate that company's performance. What did net income look like relative to revenues? What does net income actually look like when we adjust for changes in cash? Right, so there's a lot of things that we have to do to examine a company. Looking at the nominal bottom line isn't enough. It's the first step, but there are many other steps that we can take to examine a company's performance. Right, so further understanding company's performance, one of the ways that we can do that is looking through management discussion and analysis. And this provides a lot of the why behind the performance of a company in a given time period. It'll give important contextual understanding of the company's performance. It should also include discussions on right, the upsides and downsides that the company is likely going to be facing in the near future. They'll also give alternative measures of performance, right? Free cash flow. If you look through MD&A, they'll usually state, right, free cash flow is a non-GAAP measure, meaning it's not required by SEC governance to be reported in a specific format, in a specific way on a company's financial statement, but it's the measure that we use to understand value. Right? Free cash flow is the actual value being generated or destroyed in a given time period. Take anything out of this class, it's understanding cash flows and how we get them from financial statements, because this is the actual measure of value that we use to examine asset performance. And MD&A should also include some sort of performance breakdown, right? We looked across geographic segments. We looked across within firm split breakdowns, right? With Walmart specifically, it was their domestic Walmart, it was Sam's, it was their international segment. MD&A should include that breakdown of information, right? So we get the baseline information from the financial statements themselves, then we get more context for understanding that information through MD&A. If financial statements are wrong, what is happening? If they're slight revisions from just updated information, we're going to see that information adjusted in future financial statements, right? So they're not going to completely reissue their 10K. What they're going to do is in future statements and future 10Qs, 10Ks, they'll update that previously revised information in financial statements. Then there are restatements, right, where companies do reissue their entire 10K because there was some sort of material error. And it's very important to be aware of these changes when they occur. Very often when there's a revision or a restatement, it's on the downside, meaning they're revising downward. That is the typical way companies engage in these, or that's the, I guess the average result of a revision or restatement is they're revised downwards, right? Because everything else equal, companies are going to report their information in a more positive light than otherwise. So typically, any accounting assumptions that companies are using in their financial statements, which they all are typically toward the benefit of improving the company's bottom line. Right, so it's very important that we're aware of these changes and look backwards after we make investment decisions, because a company's performance can change significantly from revisions, especially restatements. And it's always important that after investment decisions are made, after the fact, we evaluate those decisions to see if we would still be making them today. Are we still making a good decision? And that's something that a lot of people aren't typically handling well, right? After the fact decision-making evaluation. After we make a decision, people tend to stick with whatever they happen to have decided on. But it's always important to look back and consider, is this still the correct decision to be making? Right? Investments can always be sold off. So should we sell or should we continue to hold? Evaluating after the fact is an important part of the decision-making process. All right, so when we're valuing a company, most of the information that we need in financial statements will trickle down into calculating a company's free cash flow. Right? And what are the information inputs that we need to calculate free cash flow? All right, we had 3 different, well, actually, no, at this point, I think we've had 4 now measures of free cash flow that we've talked about. What do we need for the lazy method? There's 2 inputs, right? That's why we're calling it the lazy method. It's only including 2 measures of value to calculate free cash flow. What's the top item? What are we starting with? operating cash flow. And then we're netting out capital expenditures, yeah. Right, so this is a lazy method because there are additional non-cash changes and cash changes that have not been included in a company's income statement. Right, specifically depreciation and amortization and change in net working capital. And those two values can result in significantly different free cash flow over a given time period. So the most commonly used approach is the bottom-up method. So we start with net income, add back depreciation, then net out capital expenditures, net out change in net working capital. Right? So in other words, we add the non-cash charges, depreciation and amortization, pure accounting expense. It's not an actual cash outflow from a company. So we start with net income, add back depreciation. Capital expenditures is a true cash outflow, but it's not reported on an income statement. Capital expenditures are cash that is being used to make investments, to invest in capital. We need to adjust for capital expenditures. Change in net working capital is money that's being tied or freed up in the production process. Right, so we need to make these changes in order to estimate a company's free cash flow. If we want it to be the most economically accurate in estimating a company's free cash flow, we would use the depreciation tax shield instead of just netting out a company's depreciation. Right? Having a depreciation expense reduces a company's capital income. That reduces the amount of taxes that the company is going to be paying. So the true change in cash from having the depreciation expense is the depreciation tax shield that the depreciation expense provides. All right, so we have three different methods that we're looking at right here. There was another one that we looked at just in PowerPoint. The bottom-up method is the most commonly used form of free cash flow, in part because it's one of the easier methods of calculating a company's free cash flow, but it includes the information that's important and relevant to cash flows. All right, so we have different ways of measuring free cash flow. It's a non-GAAP measure, but it is how we measure value. How exactly we choose to define free cash flow is up to us as an investor, as an evaluator. Whenever we're looking at the value of a business, it's basically a discounted cash flow problem. We look at the company's future cash flows that they're expected to generate, adjust it for time value of money because the timing of cash matters. Right? $1 today is not the same as $1 in 10 years, not the same as $1 100 years from now. The value of money changes across time. We have to adjust for that time value in order to get the true value of those cash flows. All right, so we get the value of the company by estimating the company's future cash flows, which we do by finding the company's growth, average cash flow growth. And then we look at its terminal value at some point in the future and take the terminal value of the company's cash flow. We put that all together to arrive at the company's overall value. In order to get the discount rate that we're applying to those cash flows, we use the weighted average cost of capital. Right? We take the weight of equity times the cost of equity. Cost of equity is not perfectly known. There are many different methods used to estimate cost of equity. The capital asset pricing model is the most commonly used method to estimate this cost of equity. We also have the weight of debt and the net of tax cost of debt. Right? We're using net of tax cost of debt because interest reduces taxable income, so it reduces our true cost for holding on to debt. Our companies have additional filings. Most of the information that we need is reported in the 10K, but if material information occurs after that 10K report or between the informational time period of the 10K and when the company finally reports the 10K, because that reporting isn't instantaneous, it takes time to build those reports, that information will be reported in the current report or the 8K. It's also important to understand what asset managers are holding on to a company, any insider trades going on, and if there's any activist investor activity. And this information is reported in part because of regulation fair disclosure. That's requiring that companies report material information to everyone if they report it to anyone. Right? So if information is being reported to any single individual or entity, it has to be reported and publicly available through anyone. And these are many of the forms that companies will be filing in order to report that information. All right. So the exam itself, you're going to have 2 days to work on your exam. It's going to open up on December 11th, and it's going to be due on December 12th. Very important that you read all the instructions before you start. You have plenty of time. You're not going to have to rush through it, but read all the instructions before you start. Basically, what you're going to do is replicate what you've worked on through your project and through your homework. Right? You're going to have to evaluate a company's performance, pinpoint why it's performing well or poorly, and discuss and compare that company to some of its peers. So you're going to be using all the tools that you've used in the project. You will be provided with the financial statements. There's going to be a couple small things you're going to have to look up, but you'll be provided the financial statements you'll be using and the cost of capital information you're going to need as well to value the company. All right, so I strongly encourage you to go back and look through your homework and through your project and understand what's going on with them. Right? Understand why you're evaluating the company the way that you are, and how would you go about evaluating another company in a similar position. It's going to be open notes, open book. You can search the internet. You can have your projects and homework open while you're working through this. The only thing you can't do is work with another person. If there's any evidence of working with another person, it's going to be a 0. So don't do it. Work on it on your own. Right. One thing it's an unfortunate thing that students look for the grades more than they look for sometimes the information itself. But right, the point of this exam is to reflect your ability to evaluate companies. Right. When you finish with your degree, your employer is going to expect you to be able to put together and understand financial statements. You have to be able to understand a cash flow, put together a cash flow table to value a company. So it's very important that you understand how to put this together. Right. You're not going to have a time pressure. You have several days to work through this. So strongly encourage you to evaluate and go through your homework, through your project. Look through the notes that I posted on your assignments in D2L. I've left feedback if you get anything wrong, pinpointing what you got wrong. So go through and look through those questions before the exam opens. That way there's time for you to ask me if you need any more clarification on any comments or feedback that I'll have time to respond. So any questions? Yes. Yes. No. No. Those 2 days. Within those 2 days. You can come back to it. You'll be able to download and use everything available to you. So yeah, as long as you have it submitted by the end of the 12th, it'll be okay. What else? It'll be available by midnight of the 11th. So like 12:01 in the morning. Yeah. Mm-hmm. Yeah. So basically, you're going to be replicating what you've worked on in your homeworks and projects. So if you understand that process, you'll understand what you're going to be doing on the exam. So definitely recommend you go through, even if you just ignore what you've done, just start the homework or the project from scratch, see if you can evaluate it. That's going to be the best way to prepare for the exam. If you can arrive at the same conclusion that you did for whatever you turned in for your assignment. Any other questions? All right. Well, that's it from me. Yeah. I will work on getting the last part of your project graded at the very latest by Friday. I'm planning on wrapping it up tomorrow. So I'll have those grades posted and commented as soon as I can. Yeah, definitely recommend you start studying on your homework and projects as soon as possible so that you keep up with this information. If you have any questions, feel free to email me. I'll still be around. Yeah, good luck on your exams.